Let's say you can borrow $50,000 at 6% for over 25 years. Over the course of the loan, you will repay $46,645.21 in interest, because over the course of the loan, the principal is reduced when you make payments. If you have that same $50,000 in a savings account that earns 6% interest over the course of 25 years, you will earn $164,593.54 in interest. Because the principal increases over the term as interest compounds. So let's look. You've earned a total of $164,593 in interest. Your loan interest is $46,645.21. The net gain to you is $117,948 plus 33 cents. Plus, you still have the original $50,000 in your infinite banking account. Now let's imagine if you just spent that $50,000, you'd be out the $50,000 plus the opportunity to earn all that interest. That's why being just a saver is not necessarily the best way to build long-term wealth. There are a number of different accounts that can be used to employ this strategy. You can use a savings account or a CD. You can use a qualified account like a 401k, IRA, or mutual fund. You can even use your stock portfolio and take out a margin loan. You can also do a home equity line of credit, or you can use permanent dividend-paying life insurance. When you are looking into the different ways to build cash reservoirs or equity, you have to look at 4 key characteristics. How safe is the account or asset? How liquid is the money in the account or asset? What is the typical guaranteed rate of return? And then ultimately, how is that account or asset going to be taxed? Let's compare a savings account or a CD. It's a very safe account for most. It's a very liquid account, but what is the rate and return of savings or CD today? Less than 1%. And ultimately, how is that taxed? Well, it is taxed as earned. So the more interest you earn in that account, the more you are taxed on it. Qualified accounts aren't much better though. 401ks, IRAs, and mutual funds. How safe is that money? Can you lose the value of your account? How liquid is the money? Can you get access to it whenever you want to? Well, actually, you can't touch those accounts until you're 59 and a half without penalty. What is the rate of return of those accounts? Well, if you're seeing the yo-yo effect of the market, it could be dismal. And then ultimately, how is that account taxed? Is it taxed as ordinary income when you pull it out in the later years? If you look at the home equity line of credit, though, it's not much better. Can you lose the equity in your own home? Of course you can. Anyone who went through the crash of 2008 knows that you can lose home equity. So when you put money into your house, it is not very safe. How liquid is that equity? Can you get access to it anytime you want to? Can you walk to your mailbox and swipe your ATM card to get some much-needed cash in a hurry? Cash out refis take at least 10 days, if not 30 days, to close and get you the money you need. What is the rate of return in home equity? It's always zero. The home value may appreciate or depreciate with the market, but home equity always returns 0% interest. And then ultimately, how is that taxed? You can also use a margin account against your stock portfolio. But again, you have to consider how safe is your stock portfolio. Can you lose value? How liquid is that account? Can you get access to it at any time? What is the rate of return on that account? And ultimately, how is it taxed? If you look at those 4 considerations, stock accounts just don't hold up. If the value of the portfolio drops by a certain amount, you can always get a margin call on your loan. That loan is due in full immediately. While many accounts may work with the infinite banking concept, obviously there are some that will work better than others. With permanent dividend-paying life insurance, the life insurance company pays an annual dividend. That dividend is applied to your cash and is guaranteed. You never lose that money. So from a safety standpoint, there is no better account. From a liquidity standpoint, the insurance carrier guarantees loans against that account. You just simply use your cash value as collateral for a loan that is given to you by the insurance company, and that's guaranteed, so it's highly liquid. The typical rates of return inside a permanent life insurance policy are determined by the dividend that the carrier pays. Those rates can vary, but they are guaranteed not to go below a certain number. And of course, every year, any dividends that are credited to your account are locked in and guaranteed, and are part of your principal never to be lost. So again, when we consider the 4 criteria, safety, liquidity, rate of return, and taxes, permanent dividend-paying life insurance satisfies all those criteria the best. Your money is safe from loss and guaranteed. It is completely liquid when you use the loan provision. Your money continues to grow and compound at competitive market rates, usually between 4% and 6%. And again, if you are using the loan provision in the policy, all the money that you are taking out in the form of the loan is considered tax-free by the government. So they are safer, more liquid, better rate of return, and ultimately you can use that money tax-free. Now the secret is to properly structure the contract so you can stuff as much cash into the policy as possible, while minimizing those expenses and charges that typically come with insurance. Now, over the lifetime of the contract, those fees and charges and expenses are going to come to generally right around 1% of the total amount of cash value that you have accumulated. Now, this is where it gets really good. Once you've collateralized that account, you have unlimited access to spend that money tax-free or to reinvest it while still earning uninterrupted compound interest on all your wealth. Let's see what that looks like. In this example, we are showing someone who is saving $1,000 a month, or $12,000 a year. And let's say that at the end of 6 years, they've accumulated $83,704, and they want to invest that money. If they would invest their own cash, they would drain the tank and have to start saving that $12,000 a year or $1,000 a month all over again, only to drain the tank again when they want to make another investment. The red chart shows what happens to your wealth when you interrupt the compounding. The green chart shows what happens to the same amount of money if it enjoys uninterrupted compound interest. If you were to add that $12,000 a year to your cash reserves and let it enjoy uninterrupted compound interest, At the end of 30 years, it would have grown to $1,017,620. But by draining your tank every 6 years and investing that money, you're interrupting the compounding of that wealth, which turns out to be a $1 million mistake. Now, what can you do with that money? Well, that's where it gets really interesting. You can use that money to pay for cars, college, weddings, or you can deploy that capital into productive assets. Now, do we suggest that you borrow against your policy and go to Vegas? No, absolutely not. But there are some things that you can do with that capital that are more productive. So where's the catch?